The world of finance is a thrilling game. Fortunes are won and lost, empires built and shattered, all on the whims of the market. But what if I told you one man defied the odds, saw beneath the surface, and made a single trade that catapulted him into the pantheon of financial legends?
Hi, business minds and financial enthusiasts. Welcome back again to Business Mind Talks.
John Paulson wasn't your typical Wall Street hotshot. Born in Queens, New York, his brilliance shone early. Graduating top of his class at NYU and Harvard Business School, Paulson carved his path through consulting and investment banking. But his true calling lay in uncovering hidden opportunities. In 1994, with $2 million in unwavering conviction, he founded Paulson & Company, a hedge fund destined to make history.
Well, again, it was structured where the downside was very limited. I think the reason why other people hadn't done it is because there had never been, according to Moody's and S&P, a default of an investment-grade mortgage-backed securities. Mortgage-backed securities were viewed as the safest securities next to treasuries. And that was essentially true up until that point. What they missed was the underwriting quality had never been as poor of securities as it had been in that period. So the fact that they hadn't defaulted in the past had nothing to do with whether or not the securities that were being issued would default in the future. Developed a specialty, which very few people do, in shorting credit. The difficulty in shorting credit is you have to get a borrow, and they're generally illiquid, so you can never get size. But I never gave up on looking, and finally we found it in the mortgage-backed securities market, which at the time was larger than the treasury market. So there was literally unlimited liquidity. And because of the development of the credit default swap market, you didn't have to get a borrow. So there was synthetic securities, just people trading synthetically on actual bonds. And you can do 100 million. We were doing 100 million at a clip, 500 million a day with banks, in some cases $1 billion a day with banks. So there was massive liquidity to set up these positions. Well, you definitely need a lot of training. So, there's a lot of issues to understand from a legal, investing, business standpoint. Before you start investing, you really need a lot of experience. And depending on the type of investing, depends on the type of experience. So, someone like in risk arbitrage or private equity, probably the best place to start is mergers and acquisitions. We become familiar with valuations and merger agreements and takeover laws, and then you could apply that later on to purchasing companies on your own behalf or trading in the securities of companies undergoing mergers. Sometimes, but the worst thing is to give someone an idea, casually, and then it turns out the wrong way. You feel terrible. So it's, I prefer not to give investment advice. I think the best thing is to invest in areas that you know well, that you can be lucky. Anyone could be lucky in a particular investment, but that's not a long-term strategy. If you invest in areas that you don't know, ultimately you're not going to do well. So the most important thing is to invest in areas, to concentrate on particular areas that you know better than other people in that area, and that's what gives you an advantage to succeed in investing. I think that they look for get-rich-quick schemes, and they buy based on stories, and then they chase investments that are going up, and ultimately those investments deflate, and then they lose money. Our viewpoint is that the markets are currently too complacent regarding inflation, and that if inflation does prove to be higher than expectations, that will result in both higher gold prices and higher interest rates. And if you get those two happening at the same time, in a period of time, we can set up positions that could, return from 25 to 50 to 1. I believe that gold does very well in times of inflation. We saw what happened the last time gold went sort of parabolic was in the 70s when we had 2 years of double-digit inflation. And the reason why gold goes parabolic is that basically it's a very limited amount of investable gold. I think it's on the order of several trillion, while the total amount of financial assets is closer to 200 trillion, and fixed income somewhere above 120 trillion. So what happens is if you own long-term treasury bonds that are yielding 2% and interest rates move up to 5%, those bonds fall materially in value. Likewise, if you have cash sitting in a bank that you're earning 0% on, and inflation's 4%, you're gradually eroding the value of your money. So as inflation picks up, people try and get out of fixed income, they try and get out of cash, and the logical place to go is gold, especially if it starts to rise in inflationary times. But because the amount of money trying to move out of cash and fixed income dwarfs the amount of investable gold, that the supply and demand imbalance causes gold to rise. And the more it rises, it sort of feeds on itself. It has the potential to go what I call parabolic.
Hey traders, if you're ready to take your skills to the next level, listen up. Introducing our online course Cash Flow Academia. From basics to advanced strategies, we've got you covered. Learn from industry pros, get hands-on experience with simulated trades, and unlock strategies that work. Don't miss out. Click the link below, enroll. And let's turn your passion into profit. Happy trading, everyone.
One of our investors called me. It was in February 07, and our credit funds were up 66% net in February. And the investor called, a German guy living in Luxembourg, and he said, John, I just got the monthly results. I think there was a mistake. It said 66%. You meant 6.6%. And I said, no, it was 66%. He goes, well, that's impossible. I've invested with Soros, with Tudor Jones, with everyone. No one's been up 66% in a year. How can you be up 66 in a month? I said, well, that's what happened. He goes, well, then you must be reporting gross returns. So 66, I said, no, that's net. He goes, well, 66% net must be 80% gross. I said, well, those are the numbers. I said, well, that's the case. And shortly after that, all our investors got these results, and it leaked out to the press and then became the cover story in the Wall Street Journal, which was picked up globally, that we had this incredible performance in February, up 66% net. And that performance continued throughout the year. The funds wound up being up close to 800% net for the year. In July, we're up like 200% net. So it became kind of a global phenomenon on this performance, and we became very well known. And it did change my life, but in a positive sense, it opened a lot of doors, to meet all sorts of interesting people. Our funds soared in value, not by raising money, but based on performance. We went from $6 billion to $35 billion of assets under management over 2 years based on performance. We became one of the top 5 hedge funds with assets under management at that time. And, opened up a lot of doors and became very interested in terms of the people that I met.
John Paulson's story is a fascinating study in risk and reward, a reminder that in the market, fortunes can shift on a dime. While replicating his feat is near impossible, his journey offers valuable lessons: the importance of critical thinking, the courage to challenge the herd, and the responsibility that comes with wielding financial power. So, the next time you look at the market, remember John Paulson, the man who dared to bet against the tide and emerged, not just a billionaire, but a symbol of the ever-shifting landscape of Wall Street. Thanks for watching. Please like, subscribe, and hit that notification bell for more video updates.